You start, so that's live.
Okay, I'm going to get us started. Thank you all for coming to the last lesson of the fall semester's Tax Law and Policy Speaker Series. I'm pleased to introduce Professor Jonathan Rhys Kesselman to all of you for this afternoon's event. Professor Kesselman has spoken in this class before, I think maybe 7 years ago. I'll make a brief introduction, although let me say this, Professor Kesselman is a retired professor from Simon Fraser University School of Public Policy, and he has been an influential figure in Canadian public finance for so long that I could be mentioning different aspects of his accomplishments, but you will have seen from the event poster that there's a wide range of public finance issues that Professor Kesselman has written on. He received a undergraduate degree from Oberlin College, a PhD degree from MIT. I think in one of his web pages, he mentioned studying with people like Peter Diamond, Robert Solow,
2 Nobel winners.
Exactly, yeah. And it's wonderful that a lot of this expertise is brought back to Canada and devoted to analyzing Canadian public finance over many decades. In fact, one distinction of Professor Kesselman's is that he's spent so much time teaching and doing research that he was able to retire from UBC 20 years ago and got a permanent parking pass at the UBC garage. Anyway, so a very long illustrious career. Thank you so much for coming to us. So today we're going to have a presentation with slides for about 40 to 50 minutes, and then a question and answer will mostly be arranged for after the presentation. Okay. Thank you.
Thank you. Yes. So it is a pleasure to be back here. I did spend 30 years with the UBC Economics Department. Capital gains is a big topic for those of you who will be practicing tax, because your clients will be mainly likely people with the wherewithal to pay your fees, and capital gains are a big item for high income, high wealth individuals. There's been a lot of interest in reform of capital gains in the last couple of years. Publications of the Canadian Tax Foundation, including their mainline journal, have had 15 articles on the topic just recently. 20 authors, mostly favoring an increase in the tax on capital gains, although not all of them. And also, the federal budget of this past spring is implementing significant changes to the alternative minimum tax, where the emphasis and most of the additional revenue is coming from changes to the treatment of capital gains. Okay, let's see how the technology is here. Okay, goals for the paper listed there. I will be dealing with each of them. I want to describe the alternative basis for taxation, explain the unique attributes of capital gains themselves, quite apart from how they're taxed, how they meld capital and labor type incomes, and their relation to supernormal returns. Then I want to characterize the role of capital gains in the existing tax provisions, summarize the statistics showing the extreme concentration of capital gains at very high income levels, and then note some of the arguments made to defend these tax preferences for capital gains, and briefly tell you what the rebuttals are to them. Then I want to outline a proposed scheme that I am advancing in the paper for a 2-tier capital gains tax. and compare it with the AMT, the alternative minimum tax reforms, and briefly note some of the precedents and the politics of reform to the capital gains tax, because we can't just sit in our ivory towers and say, this is great stuff, we should change this. It's got to work politically. And I think this type of reform could. And then some wrap up of the material. All right, this may be familiar to all of you if you've been reading a public finance textbook. The bases for a direct personal tax could be either income or consumption. These are the two main branches. Income would be the sum of labor income and capital income, where these are all measured on a real basis, taking out the inflation component, and on an accrual basis for capital income, taxing the income or the increase in value every year. That's the ideal form. And that is also the reference point for Finance Canada's accounting for tax expenditures. It's all relative to a more or less pure income base. For a consumption base, there are two alternative ways of approaching it or implementing it. And unlike the income base, these two methods differ in how they treat supernormal returns. I'll be coming back to this concept of supernormal returns. The first approach is take your income, subtract your savings, okay? And that is a measure of consumption. That is exactly how the tax-deferred accounts work in Canada and various other countries, the RRSP, and the registered pension plans. And of course, when the funds are withdrawn, they are negative savings, so they get added to your other income. So you have this deferral. So supernormal returns are going to be taxed. They're embedded in whatever you've withdrawn from the account in the withdrawals. The other way of implementing a consumption base is a so-called tax prepaid method, the tax-free savings account. And although I have some misgivings, I was involved in the research leading to the TFSA some years ago. This is simply a tax on labor income. You forget about savings, you forget about capital income. The idea is that you have prepaid the tax by not getting a deduction for your savings. And under certain assumptions about rates of return, it's kind of equivalent to the tax deferred approach, except that it doesn't catch any supernormal returns. Okay? Because when you withdraw, there's no tax. I mean, that's how the TFSA was sold. Okay, well, the Canadian personal tax is a messy mix of all of these forms and what we would call mongrel variants, things that are just a mishmash. But still, overall, it is highly favorable to top income earners and wealth holders, and capital gains related provisions play a pivotal role in that favorable treatment. So we talk about the capital gains deduction in Canada, which is 50% of your realized capital gain in a year. You get to deduct or not, exclude it. Or you could talk about it the other way. The inclusion rate is 50% of the gain is included. And both terms are used. Well, 100 minus 50 is 50, so the figures happen to be the same as they are now. And it doesn't conform to any form of an ideal tax base. The effective rate of tax on capital gains, you might say, is your realized capital gain times the inclusion rate times the taxpayer's marginal tax rate. And with the top federal rate at 33%, that means the top rate paid by anyone in the top bracket on capital gains is 16.5%, which is really quite low. It's just a bit higher than what taxpayers with incomes between about 50 and 100,000 pay on their income. And here we were talking about people with many hundreds of thousands or millions of dollars of income on their capital gains. But a true measure, a better measure, would factor in tax deferral. The fact that many of these assets are held for years or even generation. And the fact that the tax is not paid until the gain is realized means the true effective rate relative to the ideal income base, which is accrual base you'd be taxing every year, is much lower than this 16.5%. Okay. Normal versus supernormal returns, and how do they relate to capital gains? Why are they so important in this discussion? And how does the current tax system, because of the treatment of capital gains, be a major contributor to the generation of wealth inequality? Okay, standard economic theory distinguishes between capital income and labor income. I mean, this goes back centuries even. But it gets into the implications for tax policy. A lot of tax law, tax concepts do derive from economic principles, economic thinking. Recent empirical analyses, quite a number of them, find that the returns to capital, they're not just a normal return plus a risk premium. They're very heterogeneous, very different rates of return depending on who owns the capital, who manages it, who oversees it. Certain factors favor wealthier persons in getting higher or even extremely high rates of return on their financial or tangible capital. And these are what an economist would probably think of as labor type return, labor type inputs. I've listed several of them there: better education and financial literacy, greater risk tolerance and lower discount rates, ability to hold on to investments for longer, getting greater tax deferral, different portfolio asset mix, in particular more private business holdings, and there are others listed. One study found that the rate of return on wealth is highly heterogeneous. For the bottom 20th to 90th percentiles of the wealth distribution, the annual return was about or a bit below 4%. For the top 1 percentile of wealth holders, it was 8.3%, so more than double. Makes a big difference over a lifetime in terms of what did Einstein say once? One of the eighth wonder of the world is compound interest or compound returns. And the highest returns, of course, accrue to owners of private businesses. Yeah, many fail, but the ones that succeed, they eventually become public companies, they become Elon Musk, they become Bezos and others. Okay, so the key point here is that supernormal returns are a blend of capital and labor, but they're taxed as capital gains at this very favorable rate and with long deferral. Here at the bottom, I quote a tax law scholar, which hits the essence of it. What taxpayers report as capital gains income is often a form of labor income in disguise. This is especially true at the very top of the income distribution. Okay, I don't know how well your vision is, whether you can read the fine print, but I'll talk about it enough that I think you'll understand it, even if you don't have 2020 or 2010 vision. Okay, here we have the actual provisions in Canada and how we would assess them. Okay, at the top are registered accounts. RRSPs, registered pension plans, and the TFSA. Two of those use the tax deferred method, and as I've mentioned, the TFSA uses the tax prepaid method. The important attributes here are that there are limits to contributions for the two. Well, there are limits on all of them. Two of them are based on percent of earnings up to $1 cap. The TFSA has a cap of $6,500 per year with some carryover provisions. So these are not, a person could accumulate a pretty hefty RRSP over a lifetime if they had upper, middle, or higher income, but not like the multi-millionaires and billionaires. And supernormal returns, as I've said, are fully taxable in the RRSP and the RPP. For the TFSA, they're fully tax-free, but you can't put that much into them. Moreover, these three types of what I'll call registered accounts are limited in what kinds of assets they can hold. They can only hold financial assets in the public markets. You can't put your private corporation in it. You cannot put your estate house on a multi-million-dollar home that might be worth multi-millions later. So there are real limitations there. Conscious, they were in the minds of the legislators and the policymakers. So those are interesting, but those are not where capital gains treatment comes in. At the lower part of the table are the non-registered accounts, the yellow, and that includes what I will distinguish between fixed value assets like savings accounts, guaranteed investment certificates, bonds. They have no deferral. There's no legal limit in how much you can put in. If you are very wealthy, you can hold any amount in GICs or bonds. However, they don't typically generate supernormal returns. So it's the red area that is of particular interest. These are ones that have capital gains favoritism. They're treated as tax prepaid accounts, meaning there's no deduction for what you put in, but there's also no limit on how much you can put in if you're wealthy, right? Moreover, there's no limit on permissible assets. You can put in financial assets, business assets, tangible or real property. You can put in principal residences. You can buy anything. You don't get a deduction, but you're never taxed on the gain if you meet the requirements for principal residence. And shares of a qualified small business corporation have a special treatment. The first $1 million of capital gains can be tax-free. Very interesting. I think it was Peter Thiel, a billionaire in the US, put his founder's shares in the US equivalent of a TFSA. It's called a Roth savings account. They're worth billions now. They're founder's shares. You cannot put founder's shares in a Canadian TFSA. He can withdraw those at any time, not a penny of tax on them. Interesting. Very foresighted guy. Okay, so the types of assets that have the greatest potential for supernormal returns are all in the red area, all treated by capital gains treatment. Some of them, like financial, business, tangible, real property, is taxed at the 50% inclusion rate. Principal residence is taxed at a 0% rate. So these are the focus of the interest of the policy and the proposals. Okay, let's see here. So I made the claim that capital gains are extremely concentrated at the top of the income and wealth distribution. We've known for a long time from the annual tax data published by Canada Revenue Agency and StatCan that on an annual basis, capital gains are extremely concentrated at the top end. And in fact, in 2018, in a single year, Kevin Milligan, who's in the UBC School of Economics, calculated that for the very top sliver of income earners, it's a small fraction of 1%, more than half of their total incomes came from total capital gains, not the taxable half, but the total. Now, that is pretty striking. However, are these annual data, these annual patterns reflective of infrequent, very large, but or even moderately large realization of gains, or are they really a lot of recurrent gains by many people at high incomes, high wealth levels? And I know that groups like the C.D. Howe Institute, which I think is beholden to a lot of wealthy supporters, tries to make arguments that no, a lot of it is ordinary people having an occasional large gain. I don't think that holds up, frankly. In fact, we have recent several studies using longitudinal data, meaning you follow the same taxpayers over 5 years or 10 years to see whether these are recurrent capital gains being reported. How large are they? What are the patterns? And they give a very different picture. Okay, a 10-year period that tracked 34 million distinct taxpayers. That's more than there are in any year, but some people become taxpayers. They become a majority. Other people die off. So there were 34 million distinct taxpayers, a big data set.
Is that including corporations or just individuals?
Sorry?
Is that individuals or corporations as well?
These are all individual.
All individuals.
All individual, yes. Just some of the things I've highlighted in yellow. 81%, nearly 4 out of 5, never reported any taxable capital gain in any of those years. And these were people with average incomes about $32,000. So the converse of that is only about 1 out of 5 reported any, even small capital gains over that 10-year period. And it might have been in a single year or 2 years or more, but the average incomes of those reporting taxable capital gains in any year, any of the 10 years, was 85,000. And those reporting in all 10 years had average income of about 230,000 and total taxable capital gains over those 10 years of 330,000. Okay. Moreover, 56% of the total taxable capital gains over that 10 years were from taxpayers reporting in 4 or more years, reporting gains. It's really a pattern of recurrency and concentration in high incomes. Using the same data, another study that took a subset of that, 5 years, based it on family incomes because capital gains are easy to split between spouses. There are many ways I myself have used them. Nothing illegal about it if you do the documentation right. Here we find that the top 0.01% of families had average annual taxable capital gains exceeding $6 million. Here we're talking about the real upper crust. Between the top 1/10 or top 100th to 1% of families by family income, they had average annual taxable capital gains exceeding 1 million. Lots. 50% of it doesn't enter into their tax. Okay, where are we going? Okay, many arguments have been made for the capital gains tax preference, such as the 50% inclusion rate. And some of them have a measure of validity. Overall, most of these arguments don't hold up all that well. Okay, here I've listed 8 of the most common arguments that you'll find in general and in Canada. And implicitly, they're arguing against raising the 50% inclusion rate. Okay. All right, let's take up to 5 of them. I mean, if you want to ask about some of the others in discussion, I'll be glad to go through them. I might not even do all 5, but okay. The 50% inclusion rate is meant as an offset for the fact that we tax the nominal gain. Part of that is simply inflation. Part of it's a real gain. Well, I looked at stock market returns, the Standard & Poor's over 30 years. And if you just wanted to change the inclusion rate to allow for the inflation relative to the real return, you'd have a 74% inclusion rate. In other words, much higher than the 50%. Okay, and if you started indexing capital gains so that the inflation component were not taxed, you'd have a little more paperwork, and you would need, for consistency, to start indexing people's interest expense deductions. You have to start doing it through the whole tax system, capital cost allowance, all kinds of things. Or again, you introduce a new bias. Okay, capital gains preference has been argued as a way to avoid or reduce inefficient lock-in of asset holdings. And often the example is, I'm holding some shares in company X, they've appreciated a lot. There's company Y over there that maybe has better prospects, but I don't want to sell because I'm going to have to pay capital gains when I realize the sale, the gain. Well, for that example, I think it's really kind of ridiculous because what is the real capital? It's the tangible assets in company X. If I sell my shares, someone else has got to buy them. We're not able to shift or to undo the machinery, the R&D, all the things that are capital there. Now, for real tangible assets, like let's say I own an office building, or let's say I own some land on the periphery of a city that's expanding. Someone wants to buy it to convert it into a mall or to offices. And I'm reluctant to sell because I'm going to have to pay capital gains, which might be massive. But that is inefficient, not letting it go to its best use. And for this, there are ways of carving out particular assets and giving them at least somewhat favorable treatment to reduce this inefficient lock-in effect. Reducing disincentives to risk-taking. Okay. Here, the economics of it are basically that if you have asymmetries between gains and losses, you may affect risk-taking in an adverse way. But you can deal with that to some extent through averaging and carryovers. And moreover, if you think of labor, person gets training in how to repair air conditioners or how to be expert in a particular type of software, they can become obsolete overnight, some of these things. New type of air conditioner, new type of software. They have an less of an ability to diversify their investment in human capital and a much higher risk to their total lifetime wealth. So I find that a kind of odd assertion. The lumpy nature of capital gain realizations, well, here again, income averaging and carryovers can deal with a good deal of it, but people at the highest wealth levels typically are able to diversify and to time their capital gains in a way that the lumpiness, they may be in the top tax bracket every year, doesn't really matter. It's not like it's pushing them up to a still higher tax bracket because there is none. And then reducing tax avoidance and evasion. Well, let's just turn that on its head. Capital gains deduction is actually the gateway provision for tax avoidance and planning. It's the key. It's what you all, if you go into tax practice, will be trying to use over and over again for your clients. And they'll be coming back to you. So there's wastage of your brains and your human resources in trying to maneuver these things. I calculated, okay, surplus stripping, you probably know from Canadian controlled private corporations, is thought to be an ongoing problem. If you raise the inclusion rate to 75%, by my calculation, for an Ontario CCPC, it would reduce the gain from surplus stripping by over 70%. Okay. Now, I am trying to be time sensitive. What's my proposal? It's that we focus a higher inclusion rate on taxpayers above certain thresholds. And I'm not saying what that threshold should be, but I do discuss different types of ways of spelling out a threshold. Okay, so anyone above the threshold would pay a 75% inclusion rate on the amount of capital gains above the threshold, still on the amount they have below the threshold would retain the 50% inclusion rate. And you would want multi-year averaging provisions or carryover to immunize people who have only occasional amounts or not terribly large amounts above the threshold. How would you design the threshold? In another paper, I go into a little more detail, but just simply here could be the level of capital gains realized, could be the level of taxable income for those above that level who have capital gains. It could be a combination of criteria based on the amount of capital gains and the taxpayer's income. And the last one is the simplest one, and in some ways kind of appealing, a lifetime cumulative capital gains exemption. That word's not there. It could be high, it could be $1 million, could be $2 million. It should be an indexed amount. We currently have the lifetime capital gains exemption applying to qualified small business corporations of $1 million. We could merge it with that. I would also recommend, as some tax policy scholars do, and politicians are scared to do it, phasing out the principal residence exemption. Okay, what choice of the type of threshold and what levels, and also the higher inclusion rate, should it be 75%, should it be 70, 80, whatever, would have to be informed by empirical, quantitative data, and thinking about who's affected, who's not affected, what would the revenue impacts be, and so forth. Okay, I am doing not too bad on my time given when I started. Okay, the AMT reforms in this year's budget that are slated to come into force January of 2024. They're the first major changes since the AMT was introduced in 1986. The largest component, the most important component, is raising the capital gains inclusion rate for AMT to 100% and raising the AMT flat rate to 20.5%. You've studied AMT, you know what?
Not yet.
Not yet. Okay, it's a second backup tax system or provision to try to make sure that no one at very high incomes pays very little or no tax. So you calculate your regular tax in the standard way, and then if you're above certain points, you've got to recalculate it, bringing in additional income that was excluded in your regular tax, adding back deductions that were allowed in your regular tax, and then you apply this flat rate of upcoming rate of 20.5%. Okay, 20.5% with a fairly large exemption level, I think is going to, 270,000, I'm not sure, but is not all that high a rate. And it was heralded, I even have the quotes from the Globe and Mail, this is going to be a major hit to the wealthy. It's going to raise another 700 million per year for the feds, but that's just 1/3 of 1% of total personal tax revenue. And 80% of that 700 million is due to the capital gain changes. And I contrast it with the two-tier scheme, the one I described. Some economists at U of T produced a tax simulator for the scheme that I've proposed, with assuming a threshold of 50,000 per year and a 75% upper inclusion rate would generate more than 5 billion per year, or more than 9 times what the AMT reform will generate from capital gains. And the AMT reform has a lot of other nasty things in it, like disallowing capital loss carryovers, disallowing business loss carryovers. No, it's sort of a haphazard way of making sure certain people don't get to use provisions that are part of a normal income tax. It is an odd reform, but governments do things that they think are going to appeal to the public, that they can say, this is going to hit the wealthy. It's not in a big way, but certain individuals are going to be hurt in a really unfair way. Okay, so what's the difference between the two-tier approach and the AMT as it will be reformed? Okay, the AMT aims to catch small numbers of taxpayers who pay little regular tax relative to the very large incomes they have. And most taxpayers affected by the AMT will still be paying relatively little tax. The two-tier approach aims to catch larger numbers with high incomes who are paying taxes at rates that are not commensurate with the notion of a, quote, fair share under a progressive tax. And fair share is something that the Liberal government uses, the finance department uses. I guess they don't want to upset Bay Street and wealthy supporters. Who knows? That's my off the record. And the format of an alternative minimum tax has been critiqued by tax scholars as poor policy. And here I have a few quotes. They are really astonishing. They come from various tax scholars writing in Canadian Tax Journal, writing in and books on taxes by people who are super knowledgeable. Quote one, the AMT is an incredibly stupid tax with really undesirable policy consequences, and it's incredibly complicated. That's a US commentator on the US. Second quote, minimum taxes have serious drawbacks and generally make sense, if at all, only if otherwise superior options must be ruled out for reasons of optics or political economy. And a third quote from yet a different tax writer. It is hard to be sanguine about the effects of a minimum tax. At worst, a minimum tax is ineffective, in which case it would increase complexity of the tax system without any real change in equity. Okay. So there are some precedents in this whole area of tax reform related to capital gains. We start off with the Carter Commission, the latter 1960s. It recommended a 100% inclusion for capital gains. Before that, most capital gains were not taxed at all in Canada. It took a few years, but the Tax Act of 1972 acted on some of the Carter Commission points, but it adopted a 50% inclusion rate, and it cited the fact that the US at that point had a 50% inclusion rate. Both Canada and the US undertook significant tax reform, personal tax and some other taxes, in the latter 1980s, including the Reagan Act of 1986. That raised the inclusion rate to 100% in the US. It didn't last many years, but it was 100%. And the trade-off was driven by political compromise. They flattened the tax rate schedule. They really massively reduced the upper brackets. So they got the political compromise. I mean, one of the writers even cites what happened in the Senate Finance Committee. It was a trade-off. In Canada, the compromise, it followed a couple years after the US Reagan reform, raised the inclusion rate to 75%. And that stuck for a full decade of the 1990s. And it applied not only to personal tax, but also to corporate and entity tax. So we had a decade experience with it. The economy didn't collapse. I haven't seen any study trying to trace any adverse effect on the economy. Okay, so my proposal would pair the two-tier scheme with an elimination of the top federal bracket, which is 33%, reversing the hike from 29% in 2016. So it's kind of following the precedent. You're broadening the base and you're lowering the rate. Moreover, that increase in the rate in 2016 has been shown due to the elasticity of the tax base, the way that very high earners can plan and shift all kinds of things, including capital gains. It raised only 1/3 of the forecast naive, static amount of revenue. Okay. And these articles and these scholars in Canada recently recommending an increase in the inclusion rate generally favor across the board increase in the inclusion rate. Okay, so what would happen? A general capital gains inclusion rate increase, whether it's to 60 or 75%, would affect too many taxpayers for politics and also maybe for fairness. 1/5 of taxpayers over a 10-year period we saw, including some low and moderate income taxpayers, such as a fair number of retirees, would be impacted. And on the other hand, the AMT reform will affect too few taxpayers, generate too little revenue, fail to, quote, make the rich pay their fair share, even if it satisfied political optics, is what they've been called. So I argue that the two-tier approach is just right. Remember Goldilocks? She had to sample chairs and porridge and all sorts of things. She found what was just right on both the economics and the politics of reform. A national survey undertaken about two odd years ago found wide public support for closing, quote, tax loopholes. They didn't spell it out, but tax loopholes that primarily benefit the wealthy, misspelled wealthy. 60% strongly supported that, another 33% also supported it, and pretty striking that those intending to vote conservative, a majority of them also supported the closing of these loopholes. Well, of course, many or most people intending to vote conservative are not wealthy or super wealthy. So maybe not that surprising. Okay, so the proposal in this paper is to combine the two-tier gains scheme with reforms that would add public support and economic efficiency. That is, restore general tax averaging, which would benefit proprietors, many workers who have year-to-year variability in their incomes, and many investors who are not in the top tax bracket year after year. And I also, following on this kind of compromise approach, but I think it's good economics, eliminate the top federal tax rate of 33%, restore the 29% rate, so high earners who are now in the lower part and upper part of the 33% bracket, these are people who are quite well paid. You know, they're people who are techies, who are inventors, who may be unincorporated lawyers, if such exists. It would improve work incentives. It would better balance the taxation of, quote, capital income and labor income. So in my title, I had two goals. The first goal was to promote progressivity at the top end of income and wealth. I believe that the two-tier scheme addresses this element, and it's pivotal for reducing top-end inequality. Research simulations have shown that raising the top federal rate from the current 33 to 40% would have little impact on top-end inequality because of this elasticity of the tax base up at that level. But raising the capital gains inclusion rate to 100% would have a very big impact. I'm not recommending a 100% inclusion rate, but that I think is indicative. So the approach is consistent with a maxim of good tax policy: broaden the base, reduce the rate. And the second goal of reform, also in the title, was economic efficiency. I haven't said a lot here on that. Much of that is covered in another paper in discussion. I'd be glad to respond to questions. The two-tier approach captures more of supernormal returns that are embedded in very large taxable capital gains, or capital gains in general. It reduces the inefficient resource distortions from the 50% capital gains deduction. It messes things up across types of assets, types of industries. Some are able to exploit it more than others. It reduces the socially wastage of human resources through tax planning. Wouldn't you really prefer to do management consulting than tax advising to the wealthy? And if we also were to phase out the principal resident exemption, and there are many ways to do it in a very gradual way that would start to bite over many years, it would reduce the diversion of the country's capital away from productive investment. So, more funds for small businesses, small and intermediate-sized businesses. Banks love to lend to homeowners. Those mortgages, many of them are insured. They have great collateral behind them. Lending to a small or intermediate-sized business, yeah, they can charge a higher interest rate, but they are pretty risky. And so I think, although I've not seen an empirical study, I think that the principal residence exemption, I did see one study in the US suggesting something similar, that it does reduce bank lending to business and increases lending for housing. And yes, Canada has a critical shortage of housing relative to people wanting to rent or own. But it also has many people putting their extra money either into their home, upgrading it, expanding it, or buying a bigger home, thinking, okay, the gain on this, they assume there's no risk of it falling in value over years, is much better than putting it into my RRSP, where it will go into capital markets and into the business sector. Okay, how badly did I do? Oh, okay, I conclude. Okay, I am a little hard of hearing, even with the hearing aids, so if you can speak loud, I will.
So thank you for leaving time for question and answer. So maybe you can field your own questions. The floor is open for you to raise questions. I will monitor the online participants, but people in the room should just raise their hands.
Yes.
Yeah, just to start, you kind of breezed over it on the economic efficiency part. Would you mind elaborating more on why this would lead to, why it would be more efficient to tax under the system?
Okay. I may be repeating myself. There's several points. One is when governments collect revenue, when they tax us, we would like them to tax and get it from the most economically efficient ways. In other words, the ways that least distort our productive behavior. A lot of capital gains received by people at the very highest income levels and capital gain levels is supernormal returns. It's above what is needed for to compensate them for a normal return and a risk premium. That's one reason. So we should like to do that, just like we'd like to tax land at a high rate. I mean, going back to Henry George, the Georges, there is some truth. Land cannot be created normally. I mean, you can do infill in harbors, and you don't distort behavior if you tax land. If you tax the structures on it, yeah, you discourage the development of land. That's one point. Okay, another one is having a very preferential rate on capital gains affects differentially different types of investments that can exploit it or not exploit it. If you reduce that differential or preferential treatment, you reduce this distortion of resource allocation. I referred also to tax planning, which is legit. I do what I can on tax planning, but lots of human talent goes in, both investment advisors and tax advisors and legal advisors, exploiting as best as they can for their clients capital gains preference. They could be doing other productive things. There may be other reasons. That's a bit of repetition, but those are things. Yeah.
Thank you so much for this enlightening presentation, confirming some of our priors, but still interesting and always good to have more data and numbers. So two brief points. You almost touched on the first point in your very last few sentences. Do you think that phasing out the principal residence exemption will, at the end of the day, contribute to bringing housing costs down? That's one question. And the other is, do you prefer raising the capital gains tax inclusion rate, which you suggested, to an alternative of imposing a wealth tax on individuals' asset base at a level of 1% or so? And if so,
All right, let me take them in reverse order. Certainly, there are advocates of a wealth tax. There's one article in the Canadian Tax Journal, probably more favoring it. And in the US, I know the Biden administration has had advocates of a wealth tax or taxing accrued capital gains of billionaires each year on the increase in the value of their shares. These would be publicly traded shares, so you can measure. Elon Musk made a 15 billion increase in his shares this year. Tax him on it. They'll have to share, probably sell a bunch of them. Okay. Canada, as you know, does not have an estate tax or an inheritance tax. Those were abolished basically in the years following the 1972 tax reforms. Kind of a trade-off, bringing in capital gains tax, getting rid of the then existing federal estate tax, and eventually the provincial estate taxes atrophied. I think, on principle, I personally am not opposed to a general wealth tax, but politically, I think it's probably a non-starter. You may say the same on principal residence. Measuring it, there are issues. A lot of assets, if you're going to make it an annual tax on wealth or net worth, private businesses are going to value them each year. Real estate, are you going to, well, maybe you can with the property tax. I think you've got practical operational burdens, and bringing in a totally new tax, I don't think it's the best way to go. Okay, now the principal residence exemption, if I recall, the Carter Commission did not provide an exemption, did not recommend an exemption on principal residences. But, in 1972, the politicians, finance gets in the act. What will sell? That exemption came in from the start of the 1972 Act. There are ways to phase it in or to reduce the impact. The United States does tax gains on principal residences, but let's see, they've changed it a couple of times. The first $250,000 for an individual taxpayer is free of gains tax. For a couple, they allow it to be doubled to $500,000. I think a person can use it repeatedly. I don't know how many years have to pass. Another way, we could have a distinct exemption on it. I think a more promising approach, but maybe along with that, would be to allow the cost basis to be bumped up to the current value. We did this in 1972. You're holding shares in company XYZ, and they had grown from 50,000 to 200,000. Your cost basis for the capital gains tax after that would be the 200,000. Okay, you could do that on homes. You could also add indexation of the cost basis for homes. You could put together a few of these things, and few people would be affected in the years after, a number of years after. It would only start to bite over time and would not start to bite for most homeowners. I don't know, the politicians keep saying, no, we're not considering anything like getting rid of the exemption on homes. They're scared. Oh, your question about the impact on housing prices? That would require sort of a chain of analysis that no one has done. If the motive for buying a home is partially the way it's treated in the tax system, the demand for homes should decline somewhat. That should reduce the market price of homes. I really, beyond just thinking about it casually as an economist, I can't cite any really direct evidence on that.
Rhys, so David, Professor Duff has been patiently waiting online. He wanted to raise some questions.
Do we get to see him?
Oh, yeah.
Oh.
Can you see me? Hi, Rhys. Thanks for this. Sorry, I'm not there in person. I'm on leave this year, so I'm actually not in Vancouver right now. So when I read the draft, this is your longer draft that you sent me actually this in the summer that I didn't get back to you on, but it was obviously the context for your talk. I sort of wonder whether you actually really are even in favor at all of increasing the inclusion rate. You had so many concerns about economic effects and about being out of sync with the US. So I sort of got the impression that it's, well, if we have to, at least let's do it this way. So I have a variety of questions. One is, do you really actually think this is a good thing to increase the inclusion rate, or you feel like you're being reluctantly dragged into it by concerns about distribution, and that you would think that actually there are other alternatives? You identify some of them today and in the paper. For example, getting rid of the dividend tax credit on eligible dividends, which you think is completely unnecessary, doing something with the principal residence exemption, maybe doing something with the lifetime capital gains exemption. So would those be your preferred first alternatives than even raising the inclusion rate? That's the first question. Second question is, with your two-tiered threshold, do you have a preference? When I was reading through, I mean, if you're going to do it, it struck me that the one where you say a certain number of capital gains each year made some sense, partly because it's going to induce people with a lot of capital gains to at least realize some each year. That seemed to me to be the most attractive of your thresholds, but I don't know whether you have a preference. So that's the second question. The third question is, you also then hinted in the draft that I've got about carefully designed carve-outs to insulate venture capital entrepreneurs' stock options for employees in burgeoning startups from the full higher capital gains tax rates. And I wondered whether you could say something more about those potential carve-outs. So I think that's three questions. One, do you really want to do this? Two, what's your preferred threshold? And three, if there's a two-tiered approach. And then three, what are the carve-outs?
Okay, I may ask you to repeat 1, 2, and 3. One, yes, I think this is a coherent and well-justified proposal, even though I don't spell out the specifics. The carve-outs, which I didn't mention here, I think would be desirable. And here, the carve-outs and some of the like-kind exchanges that might be treated somewhat favorably, I think are based in part on wanting to be competitive in a world market and vis-a-vis the United States. I don't think they undermine the basic proposal. The threshold, do I have a preference among the formats? Not really, although the dollar lifetime amount is pretty simple to present, pretty simple to implement. And I think most people would see, oh, let's say it's $2 million. Well, for the very wealthy, they blow through that every year or most years. You'd still accomplish the progressivity aspect. But most people would say, and most people in the country are never going to see a $2 million gain on their home, right? And most of their savings are in RRSPs, registered pension plans, TFSAs. Capital gains provision doesn't come into any of them. David, did I do 3 or did I just do 2 1/4?
Okay, so you know what, the first was, do you actually believe in increasing the inclusion rate? You've said yes. The second was your preferred threshold, and then the third was the carve out. So you've addressed all of the questions I asked.
You're satisfied?
That would be a longer conversation, Rick.
We'll have that one day. Yes.
You had said that you aren't actually in favor of a 100% inclusion rate. I'm wondering why.
Okay. First, you have the politics. Secondly, you have the lack of indexation in your measure of the gain so that you're taxing only the real gain. A couple of countries have, I think it was Australia for a short, limited number of years, did go to 100% inclusion and indexation of the cost basis. I'm not sure why they abolished that and they abolished the indexation, they went to a lower inclusion rate. I don't know. 100% inclusion rate, given Canada's tax rates, would not pass through the muster of either politics or probably tax policy debaters.
Can I ask a follow-up? That's what I thought you were going to say. So there is widespread support for this idea, like you're saying. And I've seen polling in Canada and the US that says, like, I mean, the US, the Democrats and Republicans, here you could say liberals, conservatives, NEP supporters. There's like a widespread agreement amongst the public on like policy. There isn't really actually a deep divide amongst the general public on policy preferences.
Yep.
So I'm wondering, like, there's all kinds of things that they're not doing that we want them to do. Why do you think they would care about this? Like, it seems like there's a pretty strong agreement that the maximum they're willing to have as an inclusion rate is 50%. I don't see why they would start listening now. They don't care, it seems like.
Well, it's, even though in a survey, widespread support for closing tax loopholes that disproportionately benefit the wealthy.
But like even universal pharmacare is supported by pretty much all supporters of all parties. That's a specific policy.
You're asking why don't governments act on them?
I'm asking why do you think they would listen even though there is like why do you think this even has a chance?
As an academic, you could say, why should I bother writing and researching on this? There are things that maybe I or someone else could do, which have a better chance. governments act on issues that have a lot of salience and that have groups, diverse and large groups actively working, pressuring governments. This issue, since it really affects particularly the variant that I'm advocating, affects a small group of very well-off taxpayers who have a disproportionate influence on governments, on lobbying, on just their connections to government. I agree, it would be a tough sell. But ideas that at one point seem out there or a little radical may take the right change in government, the right change in attitudes, may take 10, 20, 30 years. So almost all, this is a little weak of me to argue it, but almost all progressive social legislation in Canada and in the US was opposed, resisted, it was socialist, it was unreasonable, it was too hard on business, on industry. Eventually came in. Workers' compensation, Canada pension plans, social security in the US, and Canadian Medicare, US Medicare, Medicaid. They weren't taken up quickly, put it that way. They had a lot of resistance and you needed concern over it. You know, maybe Canada becomes more divided between the rich and the not so rich, like a number of countries around the world. Politics can change, you know, not necessarily for the better when these revolutions happen. This is not a revolutionary proposal. That's the best I can do on that question.
Can I ask you, just as a scholar, about the efficiency argument for this proposal? This follows on what the student mentioned earlier. So when you talk about supernormal returns,
Yeah.
We do know a concept of economic rent. And
Yeah.
so unique investment opportunities, if you tax at a very high rate, it doesn't change your behavior. So that's the sense in which a tax on supernormal returns, defined in that way, is efficient. Mm-hmm. The question is, how have you shown that capital gains in Canada represents significant supernormal returns? What you have argued in the paper is that a lot of capital gains is mixed with labor income. It actually represents labor income. But we don't have a theory in economics that says you can tax labor income at very high rates without distortion. And so this idea of there being supernormal return, therefore efficient to tax, makes sense if you can justify it by reference to something else than saying that this is labor income. So if the main argument is to say this is mixed with labor income, the efficiency result doesn't follow.
Yeah, so I see your point. That's certainly worth pursuing. So the supernormal returns are, as I noted, the result of a combination of the owner or manager or overseer of the capital and their ideas, their energy, all sorts of things, and taxing those at a high rate is partly taxing rents, partly taxing labor income, and partly taxing the initiative and all those things. And I don't think we have any way of unpacking that or measuring it or looking at it empirically. Yeah, people may start up up a business, incorporate it, hoping it will grow, and then maybe it grows a lot. Maybe it eventually goes public. And in their mind, part of the return is it's going to be taxed when they sell the shares or they go public or go into an IPO, that they will be taxed at a lower rate. And maybe at the margin, some people will be less incentivized to do so. That is a legitimate point. Yep. And I can't separate it, but capital gains coming from land that has become urban land that was formerly agricultural land, that's more the Henry George thing where there was no incentive aspect. It was just, it's a rent, a growing rent. Could I just come back to the question there? I was involved with probably the formative paper with a colleague at the C.D. Howe Institute back in, I don't remember, years ago, that led to the tax-free savings account. Now, why did that get picked up and not a variety of other things?
I think you touched on it because that benefits people who have access to the government. Like the people that actually own this country benefit from that versus this is going to hurt them. I don't see how this stands a chance.
Yeah.
I think it's a good idea.
Yeah.
I'm not opposed to the
Yeah, no,
idea.
I appreciate the distinction you're making. And I was going to make kind of the same thing. It was picked up. Of course, C.D. Howe tends to be sort of center-right, sometimes quite right. But they have a lot of very good economists writing papers for them who are not right-wing. It was picked up by a variety of tax firms and other firms in the private sector said, this is a good idea, mainly using an argument that I and my co-author used, that this is a way to give an incentive for people at low incomes to save more because what they take out in their dotage or their old age will not be counted as income, will not count against as a callback against their guaranteed income supplement. Since then, I've seen the data on who's using it, and it's being used quite heavily by people higher up the income scale, not necessarily billionaires. I mean, they've got other things to do, but it is definitely tilted the other way. But it was taken up, as you say, for that reason. And this proposal, the fact that you have a lot of people, tax scholars writing on the topic in the Canadian Tax Journal and whatever it's called, Canadian Tax and Law Perspectives, a few of the publications of the Tax Foundation, mostly lining up for heavier taxation of capital gains, may just be the quirk, the bees that's in the bonnet of people who feel the system is not sufficiently progressive and that this is a really obvious gap. And it may not go beyond that, may not go beyond their bonnet.
So how would you sell this to those types of people? Like not the government, right? The politicians, I don't know, I've met a few MPs, they're not really deep thinkers. How do you sell it to the people who actually own this country that are going to actually line up against this?
Well, the NDP theoretically should be taking it up, but they don't.
Yeah,
What they do?
I wrote 3 or 4 op-ed articles that got published in the Globe, the Financial Post, and a couple other places. Thousands and thousands of op-eds are written each month or each year. They go nowhere. So I don't have the magic formula.
Let's make sure that other people get to ask questions. So here's one here.
Yeah, I just wanted to kind of piggyback off this conversation a little bit and just talk about I appreciate the work that you do, Professor Kesselman. First of all, institutions like the Rebutted Institute. And I think that like a point worth underscoring in this conversation is that not all interest articulation is bottom up when it comes to making issues salient, both among the public and with governments. Like a lot of it kind of functions as a two-way street and can be top down. So when a think tank, like you're talking about like the C.D. Howe Institute or the Broadband Institute, has access to people that are in Parliament, a lot of the time, like Parliament can bring up a plate of issues for people that are disaffected that they might not otherwise have a deep understanding of. So like not a lot of people who would benefit from the sort of legislation that you're talking about potentially introducing here understand tax policy to the extent that they would know that this is a gap that exists or could make it an issue that's salient and put pressure on government to change without that sort of problem being laid out for them in a digestible way or even be brought to like the forefront of like public consciousness. So I think that it's one thing to sort of analyze the issue in one direction where it's like, well, maybe we know that there's broad-based support for principles in terms of how we attack tax policy. And yet we don't see the change happening because of sort of like lobbying, et cetera. But I think that the way that you kind of counteract that is with the sort of work that we're talking about here, where people can have a conversation around the dinner table about something that's nuanced because it's been presented in a way that's digestible, and then apply the sort of bottom-up pressure because of the institutions that are making that like sort of bringing it to the forefront. So I think there's a lot of like symbiosis there that's like facilitated by having a discussion like this. I think that kind of answers the question partially between like this sort of mismatch in the policy realm that we're underscoring. And the last thing that I would add to that too is I think that in Canada that's particularly important given that the lobbying interests in Canada are mitigated to a greater extent than in places like the United States, where campaign finance laws are a lot looser. And the direct influence of people who are wealthy on government officials, the channels through which that operates are a lot more direct and a lot more profound. Like I studied law in the United States and visiting here like as a visiting scholar. I have a lot of friends who work for Congress people in the United States who spend 75% of their time fundraising between election years and only 25% of their time working on policy. Is what I hear from word of mouth. So I think that in a situation where campaign finance laws are tighter and the sort of ability of wealthy interests to infiltrate the political sphere are limited in relative terms to that jurisdiction, I think that this sort of relationship between interest articulation and which issues are salient both in the government sphere and in the public sphere are facilitated even more so by like, this sort of work. So I just thought that that's something that could be useful to add to the conversation we're just having.
Mm-hmm. Okay. One thing, I'm not sure if it's really tying into discussion, but one thing that comes to mind was the income splitting scheme that the Harper government brought in. Okay, where a couple could basically kind of average their incomes up to some limit. So given the progressivity of the tax schedule and that we tax on the individual basis, it had a real tax savings for some families. And on that issue, you had a large number of research institutes and academics critiquing it, really arguing that the presumed equity basis for that provision was really faulty in its logic and in every way. And including, if I make self-reference again, I did a paper with one of the staff members of the C.D. Howe where we dissected it and were very critical of it. But it was really across the spectrum. I can think of only one or two tax analysts who tried to defend it. Otherwise, it was really slammed completely. So the Liberals came in 2016 and they immediately withdrew it, abolished it. So that, I mean, that's It's a different kind of example. I am not I do take some time writing op-eds related to my research, but I'm not an expert on political economy or how to win friends and influence people.
Yeah, neither am I.
So if we were to leave time just for one or two more questions, we want to be wrapping up. Let's see if there are just final questions. Yeah.
That's good. So to the second goal of your reform, right, to promote the tax contribution to economic efficiency, I think that also requires a more precise definition of the supernormal and the normal return, right? So are we being overly optimistic in quantifying that regard? Will that be just as problematic as like finding the right indexation for the inflation for that? And that's why Australia is back down.
Okay. This maybe comes back to Rhys' comment. How much of these very high capital gains are really more like rents than effectively incentivizing returns for individuals to perform at a very high level, entrepreneurs, inventors, so forth. And I think, one critique of raising the inclusion rate in general, quite apart from my scheme, would be potential immigrants to Canada will look at the US. Canada, if they actually have that choice and they have some great ideas, I mean, think of the big tech firms, the big seven, several of them are headed by CEOs who had immigrated to the US. Is that going to be the difference at the margin? What is attractive about Canada versus the US for those who actually, Canada may be easier to immigrate to, but that might be one margin. My personal belief is that people don't work harder or less hard because of a variation in the ultimate return from doing a business. I'm starting a business. I'm hoping it will grow. I've got great ideas. I'm hoping to sell it, even if not going public, when I retire 40, 50 years from now. I don't think that affects likely immigration choices or native Canadian-born people and their behavior. Good questions, all of them. Yeah.
So Rhys, I just want to point out there is actually a paper in the US, I think fairly recently, showing that entrepreneurs who start successful businesses are not super young people. They are people in their early 40s. And so these people are actually very sensitive to tax rates.
They are very
sensitive to tax rates. So successful entrepreneurs are actually not very useful people. There are people who have had zero experience and they start their businesses in their early 40s.
They're sensitive to tax rates in what aspect of behavior?
Because they're, when you're in your early 40s, you are planning the, saving consumption for the rest of your life. And so you foresee what are the tax rates that are applicable to you.
And what was the population they were looking at, particular?
This is the US. And so I was going to ask you, when you quoted heterogeneous investment returns, that's probably a US study as well, right? It's not a Canadian study, right?
Yeah,
and so we're heavily reliant on US studies. But if US studies are relevant at all, then you look at entrepreneurs, are they sensitive to tax rates or are they just going into business, whatever the tax consequences are? Chances are they are people who are very highly sensitive to tax rates already. Okay, I think we need to wrap up. Thank you so much.
Okay, sure. Thank you.
Very good.